You know, usually when you open up the quarterly financial statements of like a legacy media company, you basically brace yourself for a very specific kind of tragedy.
Oh, yeah. The slow leak in the tire.
Right, exactly. You expect to see those inevitable signs of cord cutting just draining the life out of the business.
And management desperately trying to spin it.
Always. They try to spin this shrinking pie of linear television.
Right.
And at the same time, they're usually setting, literal billions of dollars on fire to fund some streaming pivot.
A pivot that is, nowhere near profitable.
Exactly. It's the story of managed decline. It's what we expect.
Yeah, and frankly, it is the standard operating procedure for the entire industry at this point. I mean, Wall Street has basically priced that managed decline into the valuation of, well, almost every traditional broadcaster and cable network out there.
Right. The assumption is just that their best days are completely in the rearview mirror.
Exactly. And now it's just about mitigating the damage, trying to survive the transition.
Which is, it's exactly why the Fox Corporation fourth quarter 2026 earnings call is such a massive shock to the system.
Oh, it really is.
You open this specific report ticker symbol, FOXA, for you listening at home, and you are not looking at a leaky tire. You're looking at a company that is somehow actually accelerating.
Yeah, it completely shatters that prevailing narrative of, doom and gloom in traditional media.
It forces you to completely recalibrate your models, right?
Absolutely. Because when a mature company in a supposedly dying sector posts the kind of operational efficiency and top-line revenue expansion we're seeing in this Q4 print, well...
It's not a fluke.
No, it's not a fluke at all. It's a structural anomaly, and it demands a much closer inspection of their underlying mechanics.
And that is exactly our mission for you today on Talk Tickers. Welcome to a very specific, very data-forward edition of our deep dive.
We're getting to the weeds on this one.
We absolutely are. We are putting our Talk Tickers lens directly on this Fox earnings beat.
Right.
We're going to strip away the corporate jargon, drill down into the actual mechanics of their pending digital acquisitions, and ultimately, we want to deliver a definitive, actionable verdict for you.
The bottom line.
Exactly. We're going to figure out whether this stock deserves a place in your portfolio or, if it's just a value trap.
Right. So we're hitting the hard data, the strategy driving that data, the forward guidance, and then that final verdict.
And the most crucial part of that whole equation is separating the headline noise from the operational reality.
Because the headlines are aggressive.
Very.
But the story of how they engineered those numbers, that is where the actual investment thesis lives.
So let's start with those headlines because, like you said, they are staggering. For Q4 2026, total revenue jumped 28%.
Which is wild.
28% to $4.2 billion. And EBITDA, the operational profit engine of the company, right?
Mm-hmm.
That improved 27% to $1.2 billion.
Right. And when you look at the adjusted earnings per share, the EPS, we are looking at $1.79.
Yeah, which is a 41% massive acceleration compared to the prior year period.
Just a huge jump.
And if you zoom out to the full fiscal year, they crossed a record $17 billion in revenue.
Up 5% overall.
Yep, up 5%, with full year adjusted EPS sitting at 5.42, which is a 13% bump.
Those figures alone are robust, but you really cannot appreciate the magnitude of that 41% EPS jump until you look at the comparison.
Right, the comps.
Exactly. In financial analysis, a quarter is really only as good as the comp it's up against.
The prior year period.
Right. And Fox was comparing this quarter against a prior year that featured both a Super Bowl and a U.S. presidential election.
Okay, wow. So those are basically the twin engines of broadcast revenue.
You literally cannot ask for a better macroeconomic setup for a TV network than an election year capped off by a Super Bowl broadcast.
They are massive cash cows.
Huge. And traditionally, the year following that setup is just brutal. You face what analysts call a comp hangover.
Right, because the revenue baseline was artificially inflated by those massive one-off events.
Exactly. So the subsequent year almost always shows a contraction. The market completely expects it.
You can price it in.
Right. So the fact that Fox managed to post double-digit growth and a 28% top-line revenue beat against those historically bloated comparisons.
It's crazy.
It indicates that their core underlying operations are just running at absolute maximum efficiency.
Yeah, and I'm looking at one specific metric that drove that revenue beat, and it frankly requires a bit of a deep mechanical explanation from you.
Okay, lay it on me.
Advertising revenue during the quarter spiked 78%. A 78% jump in a 90-day period. Now look, any investor worth their salt sees an 80% ad revenue spike and immediately assumes it's a temporary sugar high.
Oh, of course.
Because you do not organically scale ad sales by that magnitude without a massive catalyst.
You don't.
You know?
And to be clear, you shouldn't assume it is a permanent new baseline.
Right.
It is absolutely a strategically engineered spike. And it was driven entirely by their broadcast of the 2026 FIFA Men's World Cup.
The World Cup. Okay, so that's the catalyst.
But, and this is key, the World Cup itself is not the story here. The story is how Fox monetized the World Cup differently than their competitors monetize similar mega events.
Okay, that distinction is critical because when the CEO, Lachlan Murdoch, was speaking on the call, he outlined what sounded like a masterclass in cross-platform mobilization.
It really was.
They didn't just, throw the matches on the main Fox broadcast channel and sell 30-second spots.
No, they pushed this tournament through every single artery of their corporate ecosystem.
Local stations, Fox Sports,
Fox News, the Tubi streaming platform.
even the Fox One direct-to-consumer app.
Right. They weaponized their entire portfolio to drive live sports consumption.
And the mechanics of that synergy, that is notoriously difficult to pull off.
Well, incredibly difficult. Media conglomerates are always pitching cross-divisional synergy to investors.
Right, we're going to work together.
Exactly. But in reality, these divisions operate as walled gardens.
Turf wars.
Yeah. The news division doesn't want to give up their prime ad inventory to promote the sports division.
Oh, right, because it hurts their own internal numbers.
Exactly. So what Fox achieved here was actually breaking down those internal silos by spreading the 104 matches plus all the shoulder programming across all their platforms. They aggregated an audience scale that topped all networks in live event sports consumption for the entire fiscal year.
Which is wild when you realize they beat out a rival broadcast network that had both the Super Bowl and the Winter Olympics in that same window.
Yeah, NBC.
Right. They used a soccer tournament in a traditionally non-soccer dominant market like the US to completely corner the live advertising market.
Well, it highlights a broader macroeconomic reality in advertising right now. Live premium sports are basically the last remaining aggregated audience in a hyper-fragmented media world.
Because everything else is on demand or ad-free.
Right. Advertisers are dealing with plummeting returns on digital ad spend because of all the privacy changes, the tracking restrictions.
Apple's app tracking transparency stuff.
Exactly. And they cannot reach mass audiences on linear TV anymore because everyone is streaming ad-free on Netflix. Yeah.
So when a cultural event like the World Cup happens, it acts like a black hole. It just pulls in massive concurrent viewership.
Everyone is watching at the exact same time.
And advertisers are forced to pay an exorbitant premium for that concentrated attention. That is why that ad revenue number skyrocketed by 78%.
Okay, but relying on live sports is still, at its core, a legacy broadcast maneuver.
True.
The true inflection point in this earnings call, the piece of data that fundamentally shifts the valuation model of Fox, I think is Tubi.
Oh, absolutely. Tubi is rapidly moving from being this ancillary digital bet to becoming the core growth engine of the entire enterprise.
Let's break down the metrics because they're crazy. Tubi generated its highest streaming and revenue quarter in the platform's history.
Yep.
Q4 revenue was up 35%. And they reached 110 million monthly active users.
110 million. That's a massive footprint.
But the line in the transcript that should have every institutional investor sitting up in their chair is this. Tubi was EBITDA positive in every single quarter of fiscal 2026. That is the holy grail of the current media landscape.
Because streaming is usually a money pit.
Right. We are living through the streaming wars where the baseline strategy for the last 5 years has literally been cash incineration.
Yeah.
Warner Bros., Discovery, Disney, Paramount, they are collectively bleeding billions of dollars trying to scale their subscription services.
Paying for all that prestige TV.
Exactly. They pay massive upfront licensing fees for content, hoping to build a subscriber base large enough to eventually turn a profit.
And Fox completely bypassed that bloodbath.
Completely.
They acquired Tubi early, and instead of chasing the subscription video on demand, the SVOD model, like Netflix or Disney Plus, they leaned entirely into the free ad-supported streaming TV or a VOD model.
Right, but we have to be clear. It is the underlying mechanism of how Tubi acquires its content that makes it so profitable.
Okay, unpack that. How is it different from Netflix?
Well, unlike Netflix, which has to write, say, a $100 million check up front to license a library of movies.
Regardless of whether anyone actually watches them.
Exactly. Regardless of viewership, Tubi operates on a revenue share model.
Oh, interesting.
They open their platform to content creators and studios, and they only pay out a portion of the ad revenue when a user actually clicks play on that specific title.
Wow. Okay, so the capital efficiency of that model is staggering.
It's perfect alignment.
Their cost of goods sold scales in direct proportion to their ad revenue.
Yes.
If a movie gets 0 views, Tubi pays $0.
Precisely. They are entirely insulated from the massive upfront content risk that is just crushing their peers right now.
And that capital efficiency has to be compounding because of how the audience interacts with the platform. You mentioned AVOD, but I think we need to distinguish Tubi's specific viewership from the broader FAST channel market.
We definitely do, because FAST channels free ad-supported streaming TV are typically passive.
Right. It's the digital equivalent of leaving the TV on for your dog while you go to work.
Ha! Exactly. It's just linear feeds playing old sitcoms on a loop.
Right. And advertisers know that. They know a fast channel stream doesn't mean a human being is actually sitting on the couch looking at the screen.
Right.
So the CPMs, the cost per 1,000 impressions that advertisers are willing to pay for that inventory, is incredibly low.
Very low. But the data Fox presented on this call shows Tubi's viewing is 96% video on demand.
96% VOD. That completely flips the script.
It does. 96% VOD means that almost every single minute of consumption on Tubi is the result of active, intentional selection.
A user is scrolling through the interface, picking a specific movie, and actively engaging with it.
Right. And active viewing commands a massive premium in the ad market.
Because of the attention.
Exactly. If an advertiser knows the user actively initiated the stream, they have a much higher confidence level that the user is actually looking at the screen when the ad break hits.
Makes total sense.
The engagement metrics are fundamentally stronger, and that grants Tubi immense pricing power for their ad inventory compared to their passive streaming competitors.
And it gets even more lucrative when you look at the demographic breakdown of those 110 million active users.
Oh, this is the best part.
Right. Nearly 70% of Tubi's audience are classified as cordless, meaning they are cord cutters or cord nevers.
That is the exact demographic that Fortune 500 brands are tearing their hair out trying to reach.
Because if you are, say, an automotive brand or a major tech hardware company, you just cannot reach that 70% on traditional broadcast television anymore.
We don't have cable boxes.
They aren't watching the evening news. So by scaling Tubi, Fox has essentially built a proprietary pipeline directly to the exact audience that has abandoned their legacy cash cow.
Right. They hedged their own decline.
Yeah. They can go to ad agencies now and offer bundle deals. They can say, look, we will give you the older, high-income demographic on Fox News, and we will simultaneously give you the unreachable Gen Z demographic on Tubi.
It is an incredibly potent proposition for an ad buyer.
It proves that management's digital execution strategy is working flawlessly. They took this nascent platform, nurtured it through a highly disciplined content acquisition model, and grew its revenue tenfold since they bought it.
Tenfold.
And that track record is critical context for understanding the sheer magnitude of the next major announcement in this earnings call.
The Roku deal.
The pending acquisition of Roku. Now, this is where we are getting into the really dense strategic maneuvers. Fox announced they are acquiring Roku, with the deal expected to close in the first half of calendar 2027.
Right.
Now, I have to push back on this because on the surface, this looks like a massive, low-margin distraction.
A lot of analysts felt the same way initially.
Right, because Roku makes cheap plastic streaming sticks. They make low-end smart TVs.
Huh.
And historically, whenever a media company tries to get into consumer electronics hardware, they get absolutely slaughtered.
Yeah, it's a graveyard of bad acquisitions.
So why would Fox want to saddle their highly profitable balance sheet with a low-margin hardware business?
It is a valid concern, for sure. But you have to separate Roku's hardware business from their platform business.
Okay, explain that.
Fox is not buying Roku for the plastic dongles. The hardware is essentially a loss leader.
Meaning they don't care if they make money on the TV itself.
Exactly. It is a Trojan horse designed purely to get the Roku operating system into the living room.
Ah.
The real prize here, the mechanism that Fox is actually after, is platform revenue.
You're talking about the interface. The home screen when you turn on the TV.
Yes. Think about connected TV or CTV as a digital real estate market.
Okay.
Fox has always been a tenant in that market. With Tubi, they became a very successful anchor tenant. But by acquiring Roku, they're literally buying the toll booth on the streaming highway.
Oh, wow.
Roku controls the interface for millions of households. They dictate what apps are featured on the home screen. They control the native advertising you see before you even open an app.
The big banner ads.
Right. And most importantly, they have their own demand-side platform, their own ad tech stack.
Okay, let's unpack that ad tech synergy because I feel like that is where the multiplier effect happens for Fox.
It absolutely is.
Right now, before the acquisition, if someone watches Tubi on a Roku device, Roku takes a cut of the ad inventory or the ad revenue just for facilitating the stream, right?
Precisely. The platform always taxes the publisher. It's the cost of doing business.
But if Fox owns both Tubi and Roku, they completely eliminate that friction.
Yes. They internalize those margins.
And they can use Roku's massive troves of viewership data because Roku knows exactly what every user is watching across all apps, not just Fox apps, right?
Exactly. Roku sees everything happening on the device.
Right. So Fox can use that data to dramatically improve the targeting and the yield of the ads they sell on Tubi.
You nailed it. By vertically integrating the content, the ad-supported streaming app, and the underlying operating system, Fox captures the economics at every single step of the consumer journey.
They own the whole pipeline.
They are insulating themselves from the platform fees that Apple, Amazon, and Google extract from other media companies. It is a brilliant defensive moat and simultaneously an aggressive offensive revenue multiplier.
That digital strategy is incredibly compelling, but it forces us to address the elephant in the room.
The legacy linear business.
Right. We can't evaluate FOXA without looking at the traditional cable bundle because that is where the existential dread usually sets in for media investors.
The melting ice cube.
A melting ice cube. It is the defining feature of the industry's secular decline. And Fox didn't hide the melt. They reported a nearly 6.5% decline in traditional cable subscribers.
The cord cutting is real, and it is accelerating.
It is. However, and this is the crazy part, Fox's cable distribution revenue still grew by 7%.
Yep.
You have to walk me through the mechanics of that. Because on a fundamental level, losing 6.5% of your customer base while increasing your revenue by 7% from that exact same segment, it seems to defy the laws of economic gravity.
It really does sound like a magic trick. But it is the ultimate flex of pricing power in a constrained market.
Okay.
The revenue growth is driven entirely by affiliate fees.
Which are the carriage fees, right?
Yeah.
The money that cable providers like Comcast or Charter pay to Fox just to include their channels in the bundle.
Exactly. And those negotiations are famously contentious. We see blackouts all the time.
They are brutal.
They are, but Fox holds the trump card in these negotiations. What Fox has realized is that the subscribers who haven't cut the cord yet, the core audience that remains attached to the legacy bundle, they are highly inelastic.
Meaning they aren't price sensitive.
Right. And primarily, they are paying for live news and live sports. Fox News and Fox Sports are arguably the two most critical pillars holding up the entire cable ecosystem right now.
Right, because if a cable provider drops a channel that just shows reruns of old sitcoms, nobody cancels their subscription.
No one even notices.
But if they drop the local NFL broadcast or primetime Fox News?
The customer service phone lines literally melt down.
Right. The churn risk for the cable operator is catastrophic.
Exactly. Fox knows this. So they go to the negotiating table and they demand massive rate hikes.
And the cable providers just have to take it.
I mean, they scream and yell, but ultimately, yes, they capitulate. So Fox is successfully raising the per subscriber fees at a velocity that significantly outpaces the volume loss of the subscribers themselves.
They're just squeezing more juice out of a shrinking lemon.
That's a great way to put it.
But there has to be a ceiling to that strategy, right?
Right.
Eventually, the prices get so high that it accelerates the cord cutting even faster.
There is a mathematical ceiling, yes.
Which makes their strategy with their direct-to-consumer app, Fox One, so critical here. The earnings call specifically noted that Fox One is showing minimal cannibalization of the traditional pay TV business.
And that is the most delicate tightrope walk in media right now.
How so?
Well, look at the catastrophic error that companies like Disney and Paramount made. They put all of their premium content on their direct-to-consumer apps at a massive discount.
Right. Disney Plus was like $7 a month when it launched.
Exactly.
Yeah.
Which actively incentivized their most profitable cable subscribers to cut the cord. They cannibalized their own cash cow.
They literally trained their audience to pay less for the exact same product.
It was a disastrous, unforced error. Fox, however, has engineered Fox One not as a replacement for the cable bundle, but as an additive product specifically tailored for that cordless demographic we talked about.
Okay.
They are maintaining the exclusivity of certain premium live events strictly on linear TV. That ensures that diehard fans still absolutely need the cable bundle.
Right. If you want the big game, you need the bundle.
But then they use Fox One to capture incremental revenue from younger users who were never going to pay for cable anyway.
To have your cake and eating it too.
So just to recap the story behind the numbers so far for our listeners, we have a strategically engineered World Cup revenue spike. We have a highly capital efficient and profitable Tubi platform capturing the youth demographic.
Right. We have a pending Roku acquisition that vertically integrates the CTV operating system. And we have a legacy cable business that is wielding immense pricing power to grow revenue despite subscriber churn.
It is a phenomenal setup.
It is. But financial markets are forward-looking mechanisms.
Right. The past is prologue. We have to examine what management is forecasting.
Let's transition to the forward guidance. Because management laid out 3 massive tailwinds for the future. And the first one is the impending political advertising boom.
Oh, this is a huge one.
They are forecasting that the upcoming midterm elections will be a record cycle. They cited independent trackers projecting a staggering $11 billion in total political ad spend nationwide.
To put that $11 billion into perspective, it is effectively a cyclical stimulus program for the television industry.
A stimulus program, I like that.
And Fox is uniquely structurally positioned to capture a disproportionate share of that capital.
Yeah, management was very specific with their historical comps here. They noted they pulled in $400 million during the 2024 presidential election cycle and $260 million during the last midterms.
And they explicitly guided that they expect to sail past that $260 million midterm figure this time around.
What is the mechanism there, though? How do they capture so much of that political spend compared to, say, a streaming service?
It comes down to 2 things: geographic distribution and audience indexing.
Okay.
First, obviously, Fox News is the default destination for conservative political spending on a national level.
Sure, that's a given.
But more importantly, the political ad market is highly localized. Senate races and gubernatorial campaigns, they don't buy national ads. They buy local broadcast spots.
Because they only care about voters in their state.
Exactly. And Fox owns a massive portfolio of local television stations. But crucially, those stations are heavily concentrated in key swing states.
So if you own the local Fox affiliate in, like, Pennsylvania, Michigan, or Arizona.
They basically have a license to print money every 2 years.
That is incredible.
Political campaigns have a very finite window to deploy their capital, right? And they must reach high propensity voters.
Older voters who actually show up to the polls.
Exactly. They cannot rely on digital algorithms to reach senior citizens who consistently vote. They have to blanket the local 6 p.m. news with broadcast ads. Fox's local station footprint acts as a massive funnel for that localized, high-margin ad spend.
The second major piece of forward guidance management provided centers on cost predictability, specifically regarding sports rights.
Right.
And this is where the moat around Fox's business becomes incredibly deep. We are watching a hyperinflationary environment in sports rights right now. I mean, we just saw the NBA rights get carved up, with tech companies entering the fray and driving the bidding into the absolute stratosphere.
The inflation in sports rights is, without a doubt, the single biggest existential threat to traditional media margins today.
Because live sports is the only thing holding the linear bundle together.
Exactly, which means the leagues have infinite leverage over the networks.
But Fox dropped a massive piece of data on this call. They confirmed they will make absolutely 0 amendments to their existing NFL contract, which runs through the 2029 season.
That is so key.
In a macro environment where your competitors are bleeding capital just to retain their existing sports portfolios, how massive is it to have your biggest single line item expense locked in for the next 4 years?
It is unparalleled operational leverage. I mean, every other network is constantly revising their margin forecasts based on the terrifying prospect of upcoming renewal negotiations.
They're constantly sweating the next contract.
They are forced to stockpile cash or take on debt just to survive the bidding wars. Fox, on the other hand, knows down to the penny what their NFL obligations are until the end of the decade.
Which means any incremental revenue they generate, whether that's from political ads or Tubi growth or carriage fee hikes, that drops straight to the bottom line.
Yep.
They don't have to immediately hand it over to Roger Goodell and the NFL.
Exactly. It frees up massive amounts of free cash flow. And that directly informs their third point of guidance regarding digital investments.
Right.
The CFO, Steve Tomzik, pointed out that their digital investments actually moderated. They dropped from just under $300 million in fiscal year 25 to under $200 million in fiscal year 26.
That goes right back to Tubi being EBITDA positive.
Right.
When your digital growth engine is self-funding, you don't need to inject venture capital levels of cash into it anymore.
Exactly. It signals to Wall Street that the period of heavy speculative capital expenditure is over.
The heavy lifting is done.
Right. They have built the infrastructure, the platforms are scaling, and now they are harvesting the margins. Management is explicitly guiding for continued bottom line improvement going into fiscal year 27 based entirely on this reduced CapEx burden.
Which brings us to the most critical section for the retail investor listening right now.
Capital allocation.
Yep. Where did the money go? Because a company can generate all the cash in the world, but if management squanders it on terrible acquisitions or bloated executive compensation, the shareholder sees none of the benefit.
Happens all the time.
So let's look at the balance sheet. Fox ended the quarter with $4.2 billion in cash and $6.6 billion in debt. And they noted that even after they absorbed the Roku acquisition, their net leverage will sit at 2.8x.
Now, in the media sector, a 2.8x net leverage ratio is pristine.
It really is.
We have seen massive debt-fueled consolidation over the last decade that has left companies like Warner Bros., Discovery literally suffocating under the weight of their own interest payments.
Yeah, they're crippled by it.
So Fox maintaining that level of balance sheet flexibility while executing a major tech acquisition like Roku, it is a testament to incredibly disciplined financial engineering.
But the real story here is how aggressively they were returning that capital to shareholders. They increased the semi-annual dividend to 29 cents per share, which, is a nice yield. But the dividend is just the appetizer. The main course is the equity contraction. They repurchased another $2 billion in stock in fiscal year 26 alone.
The sheer scale of their buyback program is staggering, and it fundamentally alters the investment thesis for the stock.
Since the spinoff from Disney, they have bought back approximately 36% of their total outstanding shares.
Or 6%.
They have literally retired over a third of the company's equity. Let's walk through the exact mechanical impact it has on a retail investor's portfolio, because I think it's easy to gloss over the phrase share buyback without really understanding the underlying math.
It is the most powerful tool a management team has to engineer shareholder value, provided the stock is actually undervalued.
Okay, break it down for us.
When Fox takes its free cash flow, buys its own stock on the open market, and retires those shares, they are permanently reducing the denominator in the earnings per share equation.
Right. If you have, say, $100 in net income and 100 shares, your EPS is $1.
Exactly. But if you retire 36 of those shares, that same $100 in net income is now divided by only 64 shares.
So your EPS jumps to $1.56.
Yes. Even though the actual underlying net income didn't change at all, the pie stayed the same size, but there are fewer slices, so your slice got bigger.
And because Wall Street values mature companies based on a multiple of their earnings per share, that artificially but sustainably boosts the stock price.
Exactly. And more importantly, it creates a massive structural price floor.
How so?
Well, if the broader market experiences a sell-off and FOXA stock dips, management simply use their $4.2 billion in cash to buy the dip. They retire even more shares at a discount, which just accelerates the EPS accretion even further.
It effectively means that as a retail investor, if you just hold the stock and do absolutely nothing, your percentage ownership of the company's future cash flows is constantly compounding.
You are getting a larger and larger slice of the pie without having to invest another dime of your own capital.
It is a ruthless commitment to equity contraction rather than empire building.
It really is rare. So many CEOs would take that $2 billion and use it to buy a vanity project or a bloated studio just to increase their own prestige.
Right, they want their name in the trades.
But the Murdoch family is heavily aligned with shareholders because they own a massive chunk of the equity themselves. They want that EPS to compound just as much as you do.
Okay, we have ripped through the headline numbers, we've analyzed the strategic story behind those numbers, and we've mapped out management's forward guidance. That brings us to the final phase of Talk Tickers. the bottom line.
The verdict.
This is where we distill all of this data into a definitive, actionable verdict for your portfolio. Based on the totality of this Q4 earnings report and the pending Roku acquisition, are we looking at a bullish or a bearish signal?
I mean, it is exceptionally difficult to construct a bearish argument against this specific set of data. The underlying operational efficiency, the capital allocation discipline, and the strategic positioning all point to a highly, highly bullish signal.
I am in complete agreement. This is a definitive bullish verdict. And the core thesis, the reason this stock warrants a place in your portfolio, is that Fox is executing a flawless barbell strategy.
The barbell framework is the perfect way to contextualize their operations right now.
Imagine a barbell, right?
Yeah.
On one side, you have the heavy, stable weight of their legacy linear television business. It is not a high-growth asset. It is a mature, melting ice cube.
Right.
But they are managing that melt with incredible precision. Through aggressive pricing power on carriage fees, unparalleled cost certainty with a locked-in NFL contract, and the massive biennial windfall of political ad spend, this side of the barbell acts as a highly optimized, immense cash-generating machine.
And then you look at the other side of the barbell.
Exactly. On the other side, you have the digital future. You have Tubi, which has already achieved the impossible by turning EBITDA positive in the streaming wars. And you have the pending Roku acquisition, which elevates Fox from a mere content provider to a platform owner. They will control the CTV operating system and the high-margin ad tech stack that comes with it.
And the absolute brilliance of the strategy is the interplay between the two sides. The legacy cash cow on one side is fully funding the hyper-growth digital toll booth on the other side.
They don't have to borrow to build the future.
Exactly. They are successfully bridging the gap from linear to digital without taking on crippling debt and without destroying their margins, which is the trap that almost every other legacy media company has fallen into.
So let's make this actionable for you, the listener. If you already hold FOXA stock, this is a firm holding compound scenario.
Definitely.
Do not get spooked by the broader media industry's secular decline. The aggressive share buyback program retiring 36% of the float, combined with a rock-solid balance sheet and an increasing dividend, provides a massive margin of safety.
The downside risk is heavily, heavily mitigated by that capital allocation strategy.
You are getting paid to wait while management shrinks the equity base and expands your ownership stake. And if you do not hold the stock and you are analyzing it for a potential entry, the crucial takeaway is to recognize the fundamental mispricing in the market.
The market often looks at the ticker symbol FOXA and prices the stock as if it is just a legacy cable news network and a broadcast channel in a dying medium.
Right. But as we've unpacked today, that is a wildly superficial analysis.
Yeah.
You aren't just buying legacy linear television. You are buying a highly disciplined, cash-generating streaming platform and CTV operating system in disguise.
It's a value stock valuation with a highly profitable digital growth engine hidden inside of it.
It represents a rare asymmetry in public markets where the underlying fundamentals have significantly outpaced the prevailing market narrative.
The narrative just hasn't caught up to the math yet.
That is the ultimate talk ticker's verdict. Bullish. However, our job isn't just to cheerlead a good quarter, right? It's to look over the horizon. And before we close out this deep dive, I want to leave you with one final, highly provocative thought to mull over.
What you got?
Well, we spent a lot of time praising management for locking in their NFL costs through the 2029 season. They have built an incredible 4-year moat of cost certainty.
Where?
But 2029 is not that far away.
The looming cliff.
Exactly. What happens in 2030? When that NFL contract expires, Fox will have to return to the negotiating table. But the landscape of sports rights will look entirely different than it did during their last negotiation.
Oh, absolutely.
They will not just be bidding against traditional networks like CBS or NBC. They're going to be bidding against the absolute apex predators of the global economy.
The tech behemoths, Apple, Amazon, Google.
Companies with literal trillion-dollar market caps and infinite balance sheets. The terrifying reality for legacy media is that companies like Apple or Amazon do not need live sports to be profitable on a standalone basis.
No, they don't care about the advertising margins on a Sunday afternoon broadcast.
Right. They use live sports purely as a loss leader, a customer acquisition tool to trap you inside their prime ecosystem or their Apple hardware walled garden.
It completely breaks the economic model of traditional sports broadcasting. You cannot compete on a cash flow basis with a company that views a multi-billion-dollar rights fee as a rounding error on their marketing budget.
Which leaves us with the ultimate existential question for Fox and, frankly, for the entire legacy media sector. When 2030 arrives and big tech fully unleashes its balance sheet in a scorched earth bidding war for the NFL, will Fox's newly integrated linear and Roku ecosystem generate enough leverage and profitability to retain the absolute crown jewel of American television?
Right.
Or is this incredible run of operational leverage and cost certainty we are analyzing today just a golden era that is mathematically destined to end in 4 years?
It is the defining question for the next decade of media consolidation.
It is something you absolutely must model out if you are holding this stock long term. We will be tracking that trajectory every step of the way. Thank you so much for joining us for this special Talk Tickers edition of our deep dive. We hope this translated the noise of Wall Street into a clear, actionable thesis for your portfolio. Stay curious, keep analyzing the mechanics behind the numbers, and we'll see you next time.